Welcome to Illuminati Silver. We tell you the truth about silver. Today is Sunday, the 3rd of May 2020, and yesterday we published our Gold and Silver Weekly Update for the week ending the 1st of May, where we highlighted what happened to gold and silver prices last week, together with economic data to watch out for this coming week. And we've placed a link to that in the description box below if you've not had an opportunity to look at it as yet. Now, in the past 2 weeks, we have produced a range of videos on gold, particularly, why its price have both risen and fallen, why we are of the opinion there really is not a gold supply deficit per se, just that it's not currently located where it needs to be. Now, over the past few days, we've seen some interesting articles appear on Bloomberg, Reuters and MarketWatch, actually highlighting what is actually happening, including the divergence between London prices and prices in New York and the reasons behind this divergence. Also, a few days ago, the World Gold Council published its Q1 report showing essentially that if it were not for ETF demand, gold demand would actually be considerably lower. Also reported is that whilst demand for gold in the West has risen of late, demand in the East has fallen. So let's take a look at 3 articles which highlight the current situation. Bloomberg article dated May 1st, 2020. Headline: Rush for havens sparked record month for gold trading in London, by Mark Burton. The hunt for a haven as economies closed down helped boost gold trading to a record $46 billion a day in March. The value of gold changing hands jumped 36% from a month earlier, and volumes spiked to the highest in more than 2 decades, according to the London Bullion Market Association, which oversees the city's gold market. Investors have piled into gold this year, snapping up coins and bars around the world and sending exchange-traded funds holdings to a record. The search for a store of wealth as shutdowns hurt economies and central banks boosted stimulus measures has helped drive bullion prices to a 7-year high. The surge in trading also came as the pandemic put unprecedented strain on the global supply chain that links dealers in London with futures traders in the United States, miners in South America, and refiners in Switzerland. That fueled a historic dislocation between prices in London and New York. Silver trading also jumped in March. Volumes climbed 44% to a record, with average daily trading rising to $6.4 billion, the LBMA said in a report on Friday. If we now have a look at another article, which was dated the 26th of March, headline: The gold market is being tested like never before. From South Africa's ultra-deep mine shafts to vaults underneath London, from metal traders in New York, skyscrapers to Main Street sellers of coins, the global gold market is being tested like never before. The cracks are starting to show. Worldwide panic over the coronavirus outbreak and a flood of stimulus by central banks has ignited demand for one of humanity's oldest methods of storing wealth. But even though there's literally thousands of tons of gold bars sitting in vaults around the world, it's suddenly much harder to get metal when and where it's needed. Since last week, face masks, hand sanitizers, toilet rolls and bullion have something new in common. They run out when everyone tries to buy them, said Vincent Tai, sales manager at Silver Bullion Pte Limited in Singapore. Here are 4 key ways in which the gold market is being upended by the coronavirus. 1. Precious metal. Gold's age-old appeal as a store of value in a time of crisis has sent demand for metal surging. Even if companies, financial institutions and nation-states crumble, The virtually indestructible metal offers investors a way to convert their assets into high-value bars that can be stashed in a vault or under a mattress. For institutional investors like fund managers, gold offers a way to shield against losses elsewhere in their portfolios, while governments have relied on the metal as a universal currency that can provide a buffer for national reserves. 2. Not so refined. Much of the world's gold is stored in vaults in London, Switzerland and New York. The largest single depository is the New York Fed, which holds 497,000 bars stacked high on the Manhattan bedrock. In London, the Bank of England in the City of London holds a further 400,000 bars, while other vaults are operated by banks and logistics companies. The gold market links these hubs with mines spread around the globe and refineries that buy up gold ore from miners and scrap bars and jewellery and produce bars and coins of various sizes, whatever is in the highest demand. This week, 3 of the largest refiners, located in the canton of Ticino in Switzerland, were forced to close after authorities ordered a lockdown. 3. Plain talking. It's getting harder to transport gold because it typically flies around the world on ordinary commercial flights, which are being cancelled by the thousands. And while some flights are still moving, there's a limit to how much gold can go on each aeroplane. It's not weight, but value. It's not possible to get insurance for more than a certain amount on any one plane, but it's not unheard of for nations to send military planes to ship their gold around the world, complete with armed escorts. In one sign of how things have slowed down, shipping Russian gold overseas can now take about a week instead of a day, said Alexei Zaitsev, head of commodities and funding products at Otkritie Bank. 4. Spreading out. All these factors have combined to create a historic squeeze in the New York gold futures. Typically, investors buy futures to get exposure to gold prices without having to worry about the day-to-day inconveniences of actually owning the metal, while banks use futures to hedge their physical metal exposure. However, if investors hold their future contracts to expiry, they will receive physical metal in a specific form: 1 100-ounce bar or 3 kilo bars. Ordinarily, if the price of the New York gold futures rises too far above gold prices elsewhere in the world, banks simply buy kilo bars elsewhere in the world and fly them to New York. But the disruption of global supply chains has thrown that process into doubt. The result has been a sharp spike in futures prices, making metal in New York much more expensive than gold for immediate delivery in London. The surging difference, known as a spread, has rattled even veteran traders. 5. Tools down. Even mines are being disrupted, with an industry-wide shutdown in South Africa, unprecedented in its 150-year mining history, the most dramatic example. Operations are also being stopped or curtailed elsewhere, from Argentina to Canada. The above-ground stocks of gold mean production disruptions are less important than for industrial metals like copper. Still, the shutdowns will add to the shock waves rippling through the market. End of article. Market Watch article, dated 1st of May 2020. Headline: ETFs are holding up the gold market. By Andrea Riquier. ETFs bought 298 tons of gold in the first quarter. Global gold demand was up 1% in the first 3 months of 2020, while supply fell by 4%, wrote Nicholas Colas, co-founder of Data Trek Research, citing a quarterly report from the World Gold Council. During that period, ETF purchases of gold were more than 7 times as high as in the same period a year ago. ETFs bought 298 tons of gold in the first quarter, nearly as much as they bought throughout all of 2019. That took their total ownership to a new record of 3,185 tons. For gold ETFs, it was the highest quarterly inflows in 4 years, amid global uncertainty and financial market volatility, the World Gold Council said in its report. Meanwhile, most other categories of buyers were negative. Central banks bought 8% less in the quarter compared to a year ago. Demand for bars and coins was 6% lower than a year ago, and demand for jewellery plummeted 39% to a new record low. It's also important to note the supply dynamic. The coronavirus shutdowns caused mine production to fall 3% compared to a year ago, but that was enough to push it to a 5-year low, the World Gold Council said. ETF demand has helped bump pricing 11% higher in the year to date, 4% higher in the first quarter, and the precious metal, quote, is now approaching its all-time highs of $1,900 set in August 2011, unquote, Colas wrote. Colas is bullish about gold's prospects, mostly because of ETF demand. The 325 tons purchased by funds in 2019 more than offset declines in most other categories. A bigger question is demand for jewellery, he notes. In normal times, this is 50% of the end market for gold. One of the biggest markets for such demand is China, Colas said. As the country continues to reopen, quarter 2 and quarter 3 demand should improve. End of article. Bloomberg article dated April 30th by Elena Masneva. Headline: Gold market diverges with demand rising in West, falling in East. It's been a tale of two diverging markets in gold this year, with demand rising in the West and falling in the East. The hunt for a haven helped boost US and European investment in the first quarter to levels last seen after the Brexit vote and Donald Trump's election, according to the World Gold Council. At the same time, jewellery, bar and coin consumption in China and India dropped to multi-year lows as higher prices and coronavirus-led lockdowns deterred buyers. Quote, "It was an interesting diversion between East and West," unquote, said Louis Street, a market intelligence manager at the council. Gold is trading near a 7-year high and exchange-traded fund holdings are at a record as investors seek a store of wealth with the pandemic hurting economies. Prices have also hit all-time highs in currencies in nations like India, and many retail investors there sold bullion in the hope of buying again at a cheaper level, although that is harder during lockdowns, Street said. In the West, investors proved to be more cautious in selling and momentum buying was stronger, she said. Disruption to gold supply chain and panic buying in some regions drove prices in key global hubs apart recently, with bullion in China trading at a steep discount to prices in London and New York. While it's difficult to forecast demand later this year due to the virus uncertainty, gold's haven appeal is very much prominent, Street said. Institutional investors in Asia are also evidence of that, she said. While gold ETFs in North America and Europe dominated purchases, funds in India and China also saw large increases in buying last quarter. Gold demand will continue to feel the effects of COVID-19 for the rest of 2020, Street said. In particular, the divergence between investment in gold-backed ETFs and consumers via jewellery will likely continue until there is a greater economic and market certainty. Other key highlights from the Council's report include total global demand rose about 1% to 1,083.8 tonnes in the first quarter, as investment offset declines in demand from the jewellery and technology sectors, and gold supply fell 4% as lockdowns cut recycling and mine output hit a 5-year low. End of article. As we highlighted in yesterday's video, gold fell $27 last week, and some analysts believe it may have further to go down. There is no doubt in our minds, however, that the level of existing stimulus and proposed stimulus will, in time, begin to create an environment for inflation. Now, that may be as far away as 12 months, but once that begins to enter into the financial framework, then we shall really begin to see gold prices rise significantly, with silver following. What do you think? Do share your thoughts. Thank you so much for listening, and if you haven't already done so, please subscribe to our channel and press the bell sign so that you're notified of our videos as and when they are published. Not forgetting that we update our Richard and Greg channel every few days, and if you haven't done so there, please also subscribe. We hope you have found this video interesting and informative, and if so, please give it a thumbs up and share it on social media. Please ensure that you have subscribed to our channel and press the bell sign so that you are notified of any future videos. Also, kindly visit our website at illuminatisilver.com, and if you haven't already done so, please subscribe either as a free or paying member for regular email updates and offers. Disclaimer. Illuminati Silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners.